There are only two things that rule accounting: debit and credit. Everything you do in journal entries happens on either side of this imaginary line. Now let's understand the 5 types of accounts. This is where all transactions live. Assets. Assets are things the business owns, and they either bring in cash or can become cash. Examples? A machinery makes products, sell products, get cash. Inventory, bought or made, sold cash. Vehicles, ACs, laptops can be sold, and they help run the business. A cash itself, bank balance, stock investments, all are assets. Even shares in other companies, because they can be sold or pay dividends. Liabilities. Liabilities are what the business owes. Basically, future cash going out. 2 ways these show up: due by now, pay later. Like payables. Do you get cash now? Return it later. Like loans. If money's leaving your pocket later, that's a liability. Capital. This is the owner's investment into the business. Technically, it's like a liability, but you're not planning to repay yourself anytime soon. So let's just call it friendly funding. Expenses. Expenses are what you spend to keep the business going. Examples? The rent, electricity, fuel, repairs, internet, even insurance, paid annually, and depreciation, stuff getting old. If it helps the business temporarily, it's an expense. Income. Income is how the business makes money. Examples? Sales, you sell goods or services. Interest, from deposits. Dividends, from shares. And yes, in case you're wondering, profit equals income minus expense. Boom. Now, the golden rules of debit and credit. You just need to match the type of account to its natural side. Let's start with assets. If your business gets something like cash, equipment, or goods, that's an increase in assets, and we debit it. If you lose something, say you sell a laptop or pay cash, that's a decrease, and we credit it. Next up, liabilities. You take a loan, that's more liability, credit. You pay it back, liability goes down, debit. Simple, more you owe, more you credit. Less you owe, you debit. Now, capital, the owner's money in the business. When the owner puts in more funds, capital increases, that's a credit. If money's pulled out, like drawings, capital decreases, that's a debit. It's like the business saying, "Thanks, boss," or "Here's your refund." Expenses, now we're talking rent, electricity, fuel, all that daily drama. You spend more, expense goes up, debit. Maybe you got a refund or reversed a charge. Expense goes down, credit. But honestly, how often do expenses go down? Let's be real. And finally, income. Earn money? Sales go up? Interest received? That's an increase in income, and we credit it. If income drops, maybe a return or a discount, then we debit it. So quick recap, here's your cheat sheet. Asset, increase, debit, decrease, credit. Liability, increase, credit, decrease, debit. Capital, increase, credit, decrease, debit. Expense, increase, debit, decrease, credit. Income, increase, credit, decrease, debit. Examples: bought land, asset, debit. Took loan, liability, credit. Owner invested money, capital, credit. Paid rent, expense, debit. Made sale, income, credit. Once you get this logic, journal entries are just plug and play. Now let's tackle the sneaky ones. Returns. Purchase return, you returned the goods. That means assets, credit, payable, liability, debit. Sales return, customer gave goods back. Assets, debit. Cash or receivable, credit. Returns just reverse the original entry. That's the trick. Still feel unsure? Try our journal entry generator tool, links below. Type the transaction, see the correct journal entry, and get instant feedback. It's like having an accounting buddy in your pocket. Master these basics, and journal entries become second nature. Just debit the right side, credit the right side, and move on with your life. You're good to go.